Welcome to this investment webinar, sponsored by Windrose Advisors. I'm Gildas Quinquis, Chief Investment Officer at Windrose Advisors. Our guest today is Adam Rozencwajg, one of the co-founders of Goehring Rozencwajg, a New York-based investment firm focused on the natural resources and commodity sectors. Founded in 2015 by Adam and his partner Lee Goehring, the firm uses a research-driven, contrarian, and value-oriented approach to invest in energy, metals, mining, and agriculture. The opinions expressed in this discussion are those of the Windrose Advisors LLC team and our guest today. The opinions referenced are as of the date of recording and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Past performance does not guarantee future results. Forward-looking statements cannot be guaranteed. Windrose Advisors LLC is an investment advisor registered with the U.S. Securities and Exchange Commission. Registration does not imply a certain level of skill or training. Windrose reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. The information contained in this presentation is provided for informational and discussion purposes only. This presentation is not intended to be, nor should it be construed or used as an offer to sell or a solicitation of any offer to buy an interest in any fund or any other entity, which offer may only be made at the time a qualified offeree receives a confidential private offering memorandum and related subscription documents. Adam, thank you so much for speaking with us today. Obviously, the conflict in Iran makes natural resources investing very topical right now. We have a lot of questions for you, but before we jump in, I want to quickly share your background with our audience. With 20 years of investment management experience in the natural resources sector, Mr. Rozencwajg is recognized as a leading authority on commodities and renowned for his original research, spanning decades of long-term market cycles. His prescient investment themes and widely followed quarterly commentaries have cemented his status as one of the foremost experts in natural resources investing. Mr. Rozencwajg's expertise spans the entire commodity spectrum, including oil, natural gas, uranium, precious metals, base metals, and agriculture. An innovator in applying technology to investment research, Mr. Rozencwajg has also successfully integrated proprietary neural network artificial intelligence models into GNR's research process. These enhanced models offer unparalleled predictive capabilities. A sought-after speaker, Mr. Rozencwajg frequently presents at prestigious industry conferences globally and is regularly featured in leading financial publications, including the Wall Street Journal, Barron's, and the Financial Times. His thought leadership continues to shape the natural resource investment landscape, influencing both institutional investors and industry operators. Before co-founding GNR, Mr. Rozencwajg served as vice president at Chilton Investment Company. And earlier in his career, Mr. Rozencwajg was part of the investment banking division at Lehman Brothers. Adam holds a Bachelor of Arts degree with a dual major in economics and philosophy from Columbia University and is a CFA charter holder. Adam, I'd like to start our webcast by highlighting the entrepreneurial spirit of managers. Please tell us what prompted you to start a new firm with your partner Lee Goehring in what was at the time a deeply out-of-favor sector.
Thank you so much for having me today, and thank you for that kind introduction. I think it's exactly that. It was that the industry in 2016, when we started GNR, was unbelievably in the bottom of a grueling, grinding bear market. And both Lee and I are deep value investors. We're contrarians. And so the idea of starting a new product, a new fund at the top of a bull market cycle, while probably better for my financial stability, was not nearly as intriguing as starting the strategy at the very bottom. My partner Lee has been managing the strategy in one way, shape, or form since the early 1990s. He started at Prudential, and then I joined him at Chilton, where we worked together for about 10 years before founding GNR in 2016. And our real motivation was that by the end of 2015, commodities, oil, gold, copper, ag, they had all fallen into a 4 or 5 year grueling bear market. We saw oil prices go from 145 to 27, gold fell by 50%, grains fell by 70%. And we said there's just an unbelievable opportunity set in front of us. And so that's what we really wanted to try to capture in a long-only package with GNR in 2016.
You describe your investment style as contrarian and deep value. With that in mind, please tell us when you made a call to increase gold exposure in your portfolio and what drove your decision at that time.
We've been gold bulls at times, and we've been largely agnostic. We're not gold bugs. I don't think that gold has a permanent place in a portfolio regardless of outcomes. I think it's an asset class really like any other. And like any asset class, there's periods of time where it's overvalued and unattractive and should be avoided, and other times where it's undervalued. It represents incredible opportunity and should be highly aggressively allocated to in one's portfolio. We like to allocate via gold equities, so mining stocks and exploration and development stocks. Our motivation to allocate quite substantially to gold really started to take hold in 2022, but we didn't implement it for about a year and a half after that. And what we were seeing in 2022 is that gold prices had largely languished. They were hovering around $1,500. They bottomed in 2016 at 1,100, rallied up to 15, and then just sort of stayed there. And the value of most other commodities, particularly during the war between Russia and Ukraine, just skyrocketed. The energy complex notably. So we had $8 US natural gas and $100+ oil. So with $100 oil and $1,500 gold, you could buy 15 barrels rather of oil with every ounce of gold. And that's historically on the low end of things. So that meant that gold was relatively undervalued and that oil was relatively expensive. And with that in mind, we said we should probably be looking to change our allocations here. You know, there's been so much money printing and debt and financial debasement in recent years that I think there's a good positive tailwind to gold prices. But it was really that relative value that sort of got us very, very intrigued beginning in 2022. And in fact, that gold to oil ratio is almost never wrong. It's almost never a bad indicator to follow when it hits extremes. In the middle, it's almost useless. But when it hits extremes like that, it's very, very, very predictive. We had a problem at that time. And the problem was by the end of 2022, we were in the process of a rate hike cycle, the first one in several years. And gold often does quite poorly in a rate hike cycle environment. So you had all these positives on valuation, on macro. However, rates were moving in the wrong way for a gold bull. So we sort of stayed on the sidelines then for about 6 or 8 months until something happened in the later part of 2023, which was the central banks emerged as major gold buyers. Because when real rates go up, Western investors, they sell all their gold and all their gold stocks, and they were doing that in droves. But then all of a sudden, the central banks came and bought 2 ounces for every ounce that the Western investor was liquidating. So we found ourselves in a situation where valuation was compelling, fundamentals were compelling, and now this rate hike headwind had sort of been saved by the central bank. So we started allocating then at the end of 2023.
Now, you made a prescient call to rotate out of gold and into oil in your November 2025 commentary. Please tell us what motivated that call. Did you anticipate trouble in the Middle East?
No, we had no forward deployed analysts in the Middle East telling us that things were going badly. And at risk of repeating myself, that gold to oil ratio, which had approached 12 times, 15 times at the gold lows in 2022, had swung to 85 times. So a single ounce of gold could now buy 85 barrels of oil. That was unprecedented. In fact, even during the depths of COVID, an ounce of gold, oil went negative. If you take the day it went negative out and you take the $20 price sort of the next day or the day before, the gold to oil ratio by the end of last year, beginning of this year, was actually telling you gold or oil was cheaper now than it was back then. So just like gold was cheap in 2022, and that was your key to get involved, oil was extremely cheap now, and that was your key to get involved. So that wasn't necessarily a huge repudiation of gold. It wasn't us looking to get out of gold, but we were sitting on some very, very good gains. Gold stocks in our book were up over 100% last year, and we were underweight energy, and we felt that that's where the opportunity was. So we began to reallocate a little bit, like you said, in the fourth quarter, and then everything changed in January. You might think it changed with Iran, but it changed in January. And that's because you had a massive parabolic blow off in both gold and silver. And that started to change the calculus a little bit. So obviously from a valuation perspective, that was telling you even more to start to now take those gains in gold and move into something else. However, something else had happened, which I think was sort of underappreciated. And that was, for the first time this cycle, Western money really piled into gold. If you and I had sat here last October, November, when we started selling our gold stocks, we would have said, The weird thing is, even though they've done so well, we haven't seen any major buying from Western money, and that could actually be a reason they could move higher. So we're a little bit unsure. By January, that money had flooded in. The hedge funds were involved. The general public was involved, not so much on the equities, but on the GLD, on the physical gold owned mostly through ETFs. And that worried us a little bit because that, as we all know, could be fast money in and fast money out. As much as we all like to try to be value investors, I think we can agree that if gold went to $8,000 tomorrow, Western money would pour in, and if it went to $3,000, it would pour out. It is pro-cyclical. It is not contrarian at all. And so we were a little bit worried. We said, okay, look, Western accumulation could liquidate. It now seems priced to perfection. It was being done on the back of, if you remember at the time, it was relatively certain feeling that Warsh would come in and cut rates 3 times. That was now priced into gold. The central banks had actually slowed their buying a little bit, and valuations are really expensive. So we said, given how positive the fundamentals are in energy and some of these potential risks in gold, it's time to bring that allocation way down. We're in a commodity bull market. It started in 2020, and now we're 6 years in. It is very, very, very customary in these sorts of bull markets for gold to show early leadership and then take a major, major pause. And if you look in the 1970s, that pause was a pullback in gold of about 35 or 40%. Similarly, in the 2000 to 2011 bull market, it had a major, major pullback in the middle. And then it takes leadership again. I'm not saying that the gold bull market is over. In fact, I don't think we've made highs this cycle in gold. And I have to be clear, particularly with our Swiss clients who like to maintain an allocation to gold at all times. If you want to have part of your portfolio in gold, I think by the end of the decade, you'll be happy that you have it. But if you're a little bit more path dependent, I think there could be quite a bit of pain before we get that rally going again. And in the interim, energy is set to do very, very well.
Now, the Iran conflict, top of the news, it remains unresolved. How significant are the disruptions that are caused by this conflict, and how long can they last?
So the disruptions are incredible. We're talking about anywhere between 10 to 15 million barrels per day that's disrupted right now. The Strait of Hormuz before the conflict started had 20 million barrels of oil and product passing through. That has ground to a near standstill. Some of that oil is making its way out through pipelines, the East-West pipeline in Saudi Arabia, the pipeline through UAE into Europe, as well as the Iraq-Turkey pipeline. So some of the oil is getting out, and obviously until the blockade by the United States recently, some Iranian oil is getting out as well. But you're disrupting the market by 10 to 15 million barrels that is now essentially trapped and shut in the fields in the region. And that's the biggest dislocation in the oil market in human history. We've never seen anything like that. That's far larger than the dual oil embargoes of OPEC during the 1970s. And so the big question is, why aren't we seeing the gas lines that we saw in the 1970s? Obviously, the spot price has moved up. Oil stocks have done well, but not as much as you might expect given the dislocation. And there's obviously a couple things at work there. Number one, here in the United States, we have had a massive shale boom, and that means that we have a lot of security of supply here. In the rest of the world, you're starting to see physical shortages develop. And I think if you want an interesting example of that, you have physical shortages. That's very acute and understandable. In the United States, you might say, oh, we're insulated from this, but we're not, because the prices here are going to go up. Oil prices are globally consistent. They're arbitraged around the world. So it's not possible that you'll have $100 oil in Europe and $50 oil in the United States, let's say. But you can see this in work if you look at how companies are responding. So for instance, take the airlines. United just announced that they're going to increase the ticket prices through the summer by 30 to 40%. And they're going to pass that, obviously, increased fuel surcharges on to the customer. In Germany, they just canceled the flights. It's not a question of price in Germany. It's a question of fuel availability. We'll have the supply here. We might not have the gas lines, but people will pay a lot more at the pump than they're expecting to. So the physical dislocations are huge. The other thing that people don't fully appreciate is that most oil tankers that are laden with 1 million plus barrels of oil, they'll travel 3,000 to 4,000 nautical miles, and they travel at the speed of a bicycle. So we're still receiving cargoes today that were actually loaded and transited the Strait of Hormuz before the conflict started. So I think if you're a physical trader, you're trading in and pricing in a lot of this dislocation. If you're actually on the physical side receiving cargoes, things are going to get a lot worse before they get better. And that, mind you, is true even if the Strait of Hormuz opened tomorrow. It's going to take time for new vessels to load and make their way to market. So the physical disruption is absolutely monumental.
So what do you think would be the long-term ramification of this conflict? In particular, what do you think is the impact on nuclear and renewable energy?
People have asked us how we've repositioned the portfolio in response to these events. And the answer is we haven't at all, mainly because we repositioned in January into energy as well. So sometimes it's better to be lucky than to be right. So we're where we want to be, and we haven't made any changes. But in general, we don't tend to trade geopolitical events like this. And the reason we don't is they resolve themselves. Even really big ones resolve themselves. You saw that when the Houthis attacked the Abqaiq and Quraysh refinery complex in Saudi Arabia in 2019, and you're seeing it again today. This will resolve, the strait will open again, and oil will once again flow. But the longer term impacts here are that we don't think anyone was properly modeling the oil industry going into this year. We think that everyone essentially was maximally bearish towards energy and oil, and it was probably the most hated asset class in the whole world. And the reason that was the case was that everyone was telling you we had this huge surplus last year, this 2 million barrel surplus, the biggest on record. And so the biggest surplus on record meant some of the lowest prices on record. It always sort of consistent, except there never was a surplus. We never believed there was a surplus. In fact, we believed that demand was running nearly 2 million barrels a day ahead of where most people had it pegged. And what was our clue for that? Well, if the market really was in surplus by 2 million barrels a day, inventories around the world should have gone up, and they didn't last year. And that told us straight off the bat the market was actually balanced and tight. So here we are today. The strait's closed. Everyone is focused on what I call emergency Twitter trading. They'll take whatever the president says overnight and they'll buy oil or they'll sell oil that day. Any data that comes out now is immediately rejected as being not representative, distorted by the impacts of the closure. And I think the medium and longer term impacts will actually happen when the oil market, when the Strait of Hormuz opens back up, when oil begins to flow again, because the prevailing wisdom is we've taken 1 billion barrels out of inventory. And now when it opens back up, we'll go back into surplus and rebuild that back up. And within a year, we should have made up the difference. My contention is when the strait reopens, inventories will remain at these depressed levels. You will be unable to grow stockpiles back to where they had been before. And that's going to be a very, very uncomfortable realization for a lot of people. And that's when prices move up. As far as what it does for renewables and nuclear, I think largely each energy source has to stand on its own merits, meaning when you're talking about an energy system, we're firm believers that the only thing that matters is energy efficiency. How many units of energy go into the system and how many come out the other side. Nuclear is by far the most energy efficient source ever known to mankind. And as a result of that, I think it's going to continue to gain market share, and we're in a new nuclear cycle. People call it a nuclear renaissance. Renewables, on the other hand, are horribly energy inefficient. So you put 1 unit of energy in. For oil and gas, you might get 30 units of power out the other side. For nuclear, you get 100. These new SMRs would probably be up 180 units out. Renewables are probably 5 to 10 units out. So you're talking about 90% drops in efficiency relative to nuclear power. And because of that, it can't possibly compete in a modern, robust, industrialized economy. And that's why you see countries like Germany that have shut down their nukes and gone to renewables, and they've been forced to deindustrialize. You know, we claimed that 7 or 8 years ago. We said, if these trends continue, you can't run Bayer pharmaceutical plants. You can't run Volkswagen plants on a 10-to-1 energy system like renewables. That's essentially the same efficiencies you were getting in 17th century agrarian Europe. You know, you can't run a modern plant on that. So the question that people are asking now is, if hydrocarbons become risky because of choke points and we want security of supply, I understand that point, but security of supply with renewables is almost worse than useless. So will it help nuclear? I think it'll be an extra tailwind for nuclear. Will it help renewables? Absolutely not. Just look at how the renewable-led countries are doing during the crisis. You might think if renewables were the answer, then England and Germany should be weathering the Iranian situation very well, and they're both, frankly, imploding. Probably the source of fuel that will see the biggest unexpected tailwind from this, from a security of supply perspective, nobody wants to hear it, will be coal. Because people will begin to realize that that is a relatively efficient and relatively cheap way to bolster your security of supply. Unfortunately, it emits a lot of CO2, but that's going to become a secondary consideration.
Let's talk about natural gas for a moment. A significant development over the past few years has been the expansion of liquefied natural gas export capacity in the US. Can the US gas supply make up for the disruptions the world has experienced with the wars in Russia and now Iran?
Well, certainly not. Russia maybe, but certainly not Iran, because you have to remember we're now exporting 20% of our natural gas supply here in the United States. The LNG export boom, which was really part and parcel with the shale boom, you needed the shale molecules to feed the LNG export terminals, has been nothing short of remarkable. One of the first things I ever did when I started working with Lee back in 2007 was I visited the Cheniere LNG, at that time, import terminal, and there's a big ribbon cutting ceremony for it. It never imported a single vessel worth of gas, and now is one of the biggest LNG export terminals in the whole world. So talk about a change of fate in 2 decades. And those facilities have been operating flat out now for years. We export every single molecule through our export channel that we possibly can, and it is all absorbed on a global basis. And with that, in January, before all this happened, LNG prices were tight. So now you've taken potentially 20% of the LNG seaborne trade out, which also goes through the Strait of Hormuz. So no, the United States is already maxed out. It cannot make up that shortfall and difference. Part of those exports were going to Europe to offset the Russian gas that was no longer being piped into Europe after 2022. But no, absolutely not. It can't displace what's happening in Iran.
Maybe a related question. Do you think the US has actually reached energy independence thanks to the shale revolution?
Oh, undoubtedly. We can debate how independent that is. And in such a globally integrated market, the idea of true energy independence there's shades of energy independence. Again, you can talk about actual security of supply versus price exposure. We're just as exposed on a price level as the rest of the world. But as far as where the barrels are, yeah, they are disproportionately in the United States. And that is undoubtedly because of the shales. The shales have gone from 0 to 13 million barrels per day in oil, more in NGLs, and nearly 90 billion cubic feet per day of natural gas. On the gas side, that's almost all the gas we produce in the country. So without that, conventional production would be a trickle at this point. And the same thing on the oil side. We peaked oil production, conventional oil production in the United States in 1971. And if it hadn't been for the shales, we were in a 30-year downtrend, 40-year downtrend already. So yes, without a shadow of a doubt, the only reason the United States can raise prices on its tickets instead of cancel flights outright is because of the shales.
Another recent geopolitical development was the regime change in Venezuela. With a more amenable government in place, how easily could new oil supply come to market?
Well, like most things, I suppose there's a short term, a medium term, and a long term. Venezuela at peak production produced about 3 million barrels a day, and today they're under 1. So I think some people ask, well, how quickly can they just get back to where they were before? And even that's not an easy question, because there's probably 300,000 or 400,000 barrels of that 2 million barrel gap that can be brought online fairly quickly. And I suspect we'll see that in the next 9 to 12 months. After that, a lot of the equipment that was needed for the next 1.5 million, 2 million barrels of lost production needs to be reinvested. That has been completely cannibalized, stripped down, and essentially sold for scrap metal over the 15 years that the regime has imposed such a difficult hardship on its people. And that's going to require a lot of money. We think it's probably in the order of somewhere between $50 to $100 billion to get 1 million barrels a day back. It could be on the lower side, depending on if there's some stuff that's still operational. To do a full rebuild would be on the higher side of that. After that, you're talking about this claim that we hear all the time, which is Venezuela has the largest undeveloped reserves in the world. And there's an intuition, which I agree with, that if you have a lot of reserves, you should have a lot of flow. Big oil fields result in big production rates. And that is true. A lot of that is actually sort of Hubbert's theories that your reserve size base is directly related to how much you can flow on any given day. So I do agree with that. However, that's true greenfield. That is very heavy oil. It needs to be seriously processed, diluted, and upgraded before it can work its way into the refining system. And it's very sour, which means it has a huge amount of SO2 that needs to come out of it, which is very difficult, costly, and dangerous, frankly, to handle. So to get to 3 million barrels is probably going to cost you $100 to $150 billion, I suspect, from where we are today. And then to get past that is decades in the making and hundreds of billions of dollars. I suspect the oil market will need most of those volumes by the time it's ready to come online. And when you talked about a more amenable government there, that raises a lot of interesting questions too, because Venezuelan oil is very expensive. If you do the math on those CapEx numbers I told you, you need $75 to $100 oil, which today seems like it's potentially more viable. But when everyone was talking about Venezuela coming back on the market, it was in January, oil was $50 a barrel. So you need some line of sight that oil is going to be 75 to 100 for the foreseeable future. And I've heard some analysts say one lever that could be pulled is that the U.S. will get them a really great sweet deal. Maybe they don't have to pay as many taxes or royalties. And the problem with that is you're talking about investments that will take years to make and then decades to produce. So whatever Trump promises you, you realize you'll break ground probably after his administration today. And the more of a non-market deal you get with a country, the higher the likelihood it becomes expropriated down the line. And obviously the energy industry has seen that first in Venezuela itself, in places like Iran and Saudi Arabia over the years. So I think, knowing most of how the industry works, a company like Chevron, let's say, would much prefer line of sight to $100 oil and pay a fair tax rate and a fair royalty rate to keep the people happy and at bay and still be able to earn a return. At $50 oil, it just simply doesn't work.
You make a very interesting point in your commentary about the relationship between capital cycles and commodity cycles. Can you please explain to our audience what you mean by that?
A lot of this research has really informed how we think of the commodity cycle, because clearly commodities are very cyclical. They can move from the trough to a peak by 10x and then fall by 90%. And they seem to follow these predictable 20-year patterns. Not always exactly 20 years, but in that range. So you get these massive predictable amplitude and magnitude moves. And yet we were always astonished that very few investors ever stopped to ask why. And if you're going to invest in a sector like ours, where the cycle is crucially important, you should probably understand the cycle and what's driving it. And so we did that, and we looked over 4 or 5 major commodity cycles in the past 150 years. And we noticed a lot of things in common. And what we really settled on is that the commodity cycle is driven by the CapEx cycle, or the capital spending cycle in resources. And really, if you have to distill it down to one thing, which might seem a bit silly, it's the delay in making your investment to having first production. That's what creates the cycle. If there was no delay, then you might have an imbalance, you might have a deficit, prices go up, the industry turns on the machine, more oil comes out the other side, and the next day prices come back down. There's no cycle there. There might be small gyrations, but no cycle. But the problem in the resource industry is that from the minute you make the investment to the minute that first production comes online can be between 10 and 15 years, and it's getting longer. It's getting longer because the projects are getting more complicated. We found a lot of the easy to discover oil, copper, gold, what have you. We're moving deeper, offshore, shale, things that require a little bit of a different parameter. And then the environmental restraints that are being put on the industry are getting more and more onerous. And so, for instance, you have to do a 3-year baseline environmental study of a region before you can even consider what impact your mine might have. By definition, that takes 3 years, and you're not going to make that any more efficient. So for both those reasons, that delay is getting longer. So how does that work into the commodity cycle? If you think about it, imagine just sort of as an arbitrary starting point, we're in deficit. So prices scream higher, And the market's trying to find the price that will squeeze out the next unit of demand, which, as we all know, we're very inelastic, and so it can move up quite a bit before people actually change their behaviors. And eventually, after maybe a year or two of that, it attracts investor interest. And with investor interest comes investor capital. They do IPOs, secondaries, debt offerings, what have you, every sort of esoteric financing you can imagine. And eventually that money gets put into the ground, invested in new projects. And what does that do? Well, it starts the 10-year fuse that gets lit, or stopwatch that gets started. And the year after that happens, prices go up even more because you still haven't brought on the new supply to meet demand. And more money comes in. And eventually, just like there's this sort of R star mythical interest rate that balances the market perfectly, there's a C star, which is the perfect amount of capex that will bring on the perfect amount of supply to balance the market down the road. What happens after you reach that point? Prices still go up because that supply hasn't come online. So investors inevitably will put too much money into the sector. All that money after C star is over investment, right? And it's funny because if you talk to investors about it and you said, look, we've raised the right amount, just stop now, no new deals, they would say one of two things. They'd either say, I have no idea what you're talking about, or they would say, I get that, but the deal's going to go up and I'll get out before everybody else does. And of course, not everybody can do that. So what ends up happening, you bring on the right amount of supply, the market is no longer in deficit, the cycle begins to plateau, things even out. And what's behind you? A tsunami of new projects that have come after that perfect amount of capital has been invested. So the market slips into surplus, prices collapse, investors look like fools, people swear off the industry for decades. They say, I'll never do that again. Unfortunately, I'm convinced that the majority of investors are doomed to have a bad experience because it's in fact their capital coming into the space that pushes things into surplus. And you talk to people and they say, oh, I had a bad experience last cycle, I don't want to be involved. So the money comes pouring out, depletion starts to take hold, you ratchet that surplus tighter and tighter and tighter. People still have sworn it off, and eventually the market slips just ever so slightly back into deficit. And you start all over again. That's where we like to focus. These areas where it's just been left for dead, where people have been burned the whole way, they've sworn it off forever, and the supply and demand fundamentals have quietly gotten better, and no one's paying attention. And I think the fact that a whole cycle lasts basically one investment lifetime is crucially important because there's no one to tell you the mistakes from the last cycle. So you're bound to repeat them.
So where are we today? Many commodities have experienced eye-popping runs since 2022. Is it too late for investors to invest in natural resources equities?
We've committed to telling people where we think we are in the commodity cycle since we started the firm. And you have my commitment that when I think we're approaching the top of the commodity cycle, we're not going to be shy in telling people that. And frankly, I suspect I'll raise more money at that quarter when I tell everyone that the run's over. They'll say, look, you just pick the stocks. Let us worry about the asset allocation. Just like I wasn't able to raise any money when I told people it was the bottom. Why do I think we're at the very, very early innings yet? Well, there's a couple things that we like to look at. The first bit was the theory, why the cycles are the way they are. This is the practice. How do you measure where we are? What are mile markers we look for? And one of the ones that we like to look is, of course, how much capital has been put into the system. It's still very, very low. You haven't seen any real new oil projects that have been sanctioned in 3 or 4 years. The only things really on the pipeline are what's happening in Guyana and Suriname, and those were sanctioned 10, 15 years ago. The IEA put a great piece out that really clearly shows the hole that we have there. Some areas have seen capital investment. Those are the ones we stay away from. Lithium, for instance, has seen a lot of capital investment. We're not involved there. Copper has honestly seen a lot of capital investment, and we've been lightening our load there. But for the rest of it, it's still very low. Energy weighting in the S&P today is 4%. The long-term average is 15. Bull markets end at 30. The all-time low is 2. So if you think about from 2 to 30, we're at 4. This is just getting started. And in fact, you look at all the flows of funds into the different commodity complexes and funds, and not to pat ourselves on the back, but most of our peers haven't raised any money. We've been able to raise money, but the industry in general has not at all. And that, I think, is just telling you we're still very early in that cycle. And the last thing we like to look at is we like to look at the price of commodities versus the price of stocks. It's a chart that we've become fairly well known for. We've been putting it out for a long time. We stole it from Jeffrey Gundlach. He stole it from BCA Research, so it's made its rounds. But we're happy custodians of the chart now. And I think we've put a little bit of, we've extended it farther back than other people have. It's incredibly predictive in the sense that at certain times, commodities are very, very attractively priced relative to stocks. So the commodity to stock ratio is very low. And at other times, it's very, very high. And every time it's been high, it's signaled a bear market. Every time it's been low, it's signaled a bull market. And right now, with the exception of COVID, we're at the lowest it's ever been in history. If you put COVID in, obviously it was a little bit lower then than it is today. So I think, yes, we're 5-6 years into this. I suspect that ESG and environmental concerns maybe delayed some of that institutional capital coming back. We haven't seen the money come back into the space yet. We haven't seen the new projects get sanctioned yet. Those are all the sort of kiss of death for late stage cycles. And when you look empirically at where we are in these different ranges, we're basically pinned to the bottom. So I would argue probably for most investors, this is the sweet spot to get involved. For very, very enterprising investors, there was better value 4 or 5 years ago. You could have gotten a higher return off the bottom. Fine, I get that. But you needed to call the bottom and catch the falling knife. Here we are. The market seems to be firmly entrenched in a bull market, but realistically, on any measure of what inning we're in, it's the second or the third at the latest.
Investors are attracted by the lower cost of passive investing. Why do you think an active strategy is preferable in natural resources equities?
Well, so I think there's really two things that we do as active managers that's fundamentally different than the passive vehicles that are available. The first is we look at every commodity subsector and we look for these areas that are bombed out. So for instance, last year, we were very, very bullish on gold. We had at our maximum weight on an intraday basis, 27% of the fund invested in gold. That's a full position for us. 25 is a full position. We sometimes will let it run a little bit. We've taken that down to 5% now. Energy last year was 30%. We've taken it up to 50%, split between oil and natural gas, two themes at 25 apiece. And that ability to move from sector to sector, if you think we're good at picking the right sectors, which we have a long track record of doing that actually quite well based on our research, then that provides a dimension of returns that's just simply not available in a static allocation like most of the passive vehicles are, which the big one that everyone uses, the S&P Global Natural Resource, has a third energy, a third mining, a third ag. Being able to take gold to 25%, then down to 5%, uranium up to 25% at times as well, has been a massive tailwind for us. And if you look at our attribution, that shows very, very clearly. I suppose investors could try to replicate that through a series of dedicated ETFs like the copper ETF and the uranium ETF. But what we've found is that the volatility in each group is so great that people usually end up selling at exactly the wrong moment. Whereas if you can blend it into a portfolio like we do and have the research bear out, it has a very good risk return profile. The next is from the bottom up, where most passive vehicles will, once they have their sectors weighted, will look to allocate on a market cap weighted basis. And the problem with that is that in our sector, you are dominated by these super majors. In the oil business, it's your Exxons and Chevrons and Conocos. And in your mining business, you have your BHPs, Rios, and Glencores. And the problem with those companies, they're good, great business models, but the difficulty for us and our strategy and why we avoid them is that in many cases, they're somewhat insulated from the move in the underlying commodity price. So for instance, Exxon is vertically integrated. They have refining and pipelines and distribution. And if oil prices drop, they'll make more money on their refining business, et cetera. That's a good way to run a business. And if you look back in the history of Standard Oil, Rockefeller was terrified of moves in the oil price. And so he built this very robust company to insulate himself against it. Great way to run generational wealth. However, not a good way to get exposure to an oil cycle. And that's what we like to do. And the way the mining houses work, they don't vertically integrate, but they have so many product lines that they figure if one commodity lags, another one will be able to provide subsidy for that. You know, if iron ore goes down, then uranium can pay iron ore, whatever. Again, a good way to run a business, and that's probably why they grow to be these big behemoths, but not a good way to get exposure to uranium, if that's what you're after. So what we do and what I think we do very, very well, is we pick the sectors extremely deliberately and quite accurately. Not always with the best timing. We tend to be a little bit early sometimes. And then we look for companies that will give us that targeted exposure to the move. And so everything's very, very deliberate. It's set up exactly the way we like to achieve a maximum capture in a commodity bull market. And so in bull markets, we tend to do very, very well as active managers. We tend to outpace our benchmarks quite handily because I think the static weights and the huge concentration amongst the super majors.
Adam, you and Lee travel to far-flung places to conduct on-site diligence. Where will your travels take you next?
We don't have a next trip planned. Lee right now as we speak is in Algeria, although I'll be transparent, and I think that's more for pleasure than it is for on-site diligence. But he was recently down through South America and Suriname and looking at projects there. One of the areas that we're keen to go and visit is mainland China, to go and see what's happening in their battery industry there, because we, for a long time, have been very skeptical of widespread improvements in lithium-ion battery technologies. And we've been right, actually. We've been proven right. Everyone sort of thought that those prices would continue to collapse exponentially, and we really dug into the physics and science behind that and came with a different conclusion. Now they're sort of claiming a new breakthrough in heat management mostly, which is allowing for better densities and ranges, et cetera. And I'm keen to go and see what that's all about. So I think that might be our next trip.
Thank you for sharing your insights with us today. Best of luck to you navigating these volatile markets, and I look forward to our next conversation. And to our audience members, if you're interested in reading Adam and Lee's latest market commentary, please visit goehrozen.com. For more interviews, subscribe to our YouTube channel.